Well, hello and good morning, active traders. This is Ken Calhoun with another video. This time we're going to look at the importance of taking small initial stops and minimizing your upfront risk to give you more chances to get things right when your trades do work out. Let's go ahead and take a look at what we've got for you today. You know, traders really like asking me questions in real-time markets at my live room at tradingtheopen.com and also on the weekends on my Saturday Swing Scans event. So do bring your questions for all of you who are members. As always, all information is for educational use only. We're not making advice about what to buy, sell, or hold. Let's begin with the day trading example from yesterday, January 25th. My first trade was a winner, and I correctly traded it on the breakout on the way up. My second trade was a stop, and you can see I bought it at 43.20. I took a stop at 42.5. I gave it more wiggle room than I normally do, and it cost me, but only around $50, right? The cost of being wrong in this 70 share trade. So that's only about $56, $60 for the stop loss cost, which is really small for a professional day trade. Again, only 70 shares. That's one of the keys to trading smartly and more safely, instead of trading 1,000 or 2,000 shares where that stop loss would have cost me, you know, $600 or $800 or whatever. Trading a much smaller initial size is really the right way to do it. You do that for both day and swing trades. I like to day and swing trade. I do both, and for my day trades, I like to, the stop loss costs are always under $100, and I like to keep them usually down to break even or $20, $30, $40 on an initial trade, and then I'll double down or scale into it once it starts to work out to keep the upfront cost as small as possible. So remember, don't ever day trade with 1,000 shares or more out of the gates like some of these young, inexperienced guys talk about on YouTube. What they don't tell you is the huge stop losses they suffer, right? They only try and say, I'm up $3,000 today. They don't tell you about the $5,000 stop loss they took the day before or the hour before. So play it safe, play it small. Next, let's take a look at swing trades and correct strategies for that. Here's a good example of a chart, HUYA, the ticker, and you can see that it ran up to 22.5 on Friday. So that's a nice breakout above both moving average lines. Now, if I buy it for a swing trade, I might buy it at say 23.50. My stop loss cost will be no more than down to 22, maybe 22.5. I use stops on swing trades of no more than a couple of points, and usually even tighter than that. That way, if I go on a trade and it goes against me or goes sideways and starts to drop, I can always take a small stop, re-enter the trade on a subsequent breakout. Look at some of these charts. This illustrates the pattern. OSTK, it's bouncing, and a buy somewhere over 20 would make sense, but a stop loss at 19 also makes sense, right? Here's another chart, ON. You see how it's poised for a breakout. It's almost at a 90-day high right near 20.5. So if I buy it at 20.7, I'll put a stop loss no further down than say 19.7. And I'll only trade it maybe 50, 70 shares. I'm not going to do a 300 or 500 share trade. That's one of the keys to success in trading is small initial size. You kind of duck and weave and you take a lot of shots at the market. You grind away at it. So 50 shares, 100 shares tops on anything I like to trade. That way, if I'm wrong, which I'm wrong often, it doesn't cost me much. And when I'm right, and I'm right often too, I can scale in or double down into the trade. So if I do say just a 50 share trade at 20.7 and it stops me out at 19.5, that won't cost me much. Let's say I buy it again at say 20.8 for a secondary entry. And that one does work out. It starts to go up. Then I buy another 50 shares up at 21.8. Then another 50, maybe 100 up at 22.8. You kind of martingale your way in or scale your way into the trade by adding when it works out and taking small stops when it doesn't. So the upfront, minimizing your upfront risk as a trader is absolutely critically important. And that gives you two important things. One is it buys you more chances to get a trade right. You're not going to make a lot of money on the front end on a 50 share trade, but you're not going to take a big stop loss most likely either, right? So that's the key to success for day and swing trades. I mean, because take a look at this WDC chart for intraday. Now, I did successfully trade the first breakout, and I wanted to trade a bounce but a bounce never really occurred. We had these little tiny bounces, but nothing really tradable for much of a big gain. Now, if I had done 1,000 share bounce trade at 42 or 43.20, that would have cost me a lot of money. As it was, it's under $100 for the stop. So that's how you trade. Trade small, trade more often, trade what I call trade wide, not deep, and let's go get them. So anyway, best wishes for success in your trades, and I think you can learn a lot from, and let me know in the comments below or wherever you're looking at this. Hit me up with an email or something, but I do like to try and share lessons learned from my stops as well as my wins and show you the difference between the two. That's what my business is built on. I like to be very transparent. If you take a look at some of the, I was sharing this with my traders in my live room at tradingtheopen.com. You do want to be sure to try and join that if you're a day trader, or swing scans if you're a swing trader, and get a bird's eye view of some of the trade setups that I take, with actual trades, and learn from the tiny small stops I take as well as the big wins, and figure out the difference between the two with me. So anyways, best wishes for success in your trades, and I'll see you guys in the members area coming up. Bye for now. Trade smart.